When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave Chase and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Income, legacy, growth, it's all right here at ILG Financial. And you've got the Retire Your Way podcast. Thanks for listening today. It's all about helping you plan for retirement your way so you can achieve your financial goals. You can call ILG Financial at 540-720-5656 or go online to ilgfinancial.com to learn a whole lot more. Today is a very special show because we're going to talk about long-term care and all the ramifications of long-term care. Who needs it? How do you get it? How important is it? All of those questions will be answered today. I'm Ron Stutz, and of course, as always, Dave Lopez is here from ILG Financial. And today we have a special guest to talk about long-term care, Alecia Barnette. Dave, why don't you tell us about Alecia and all of the things that we need to talk about before we launch into that discussion?
I will, and thank you, Ron. And it is literally my pleasure to introduce Alecia. We have been working together, Alecia. I am embarrassed to say this. It makes me sound older every time I say it, but we're going on, believe it or not, 18 years working together, if you can believe that.
Wow.
And you were arguably an old hat in long-term care even then when we first met. Alecia, for those of you who are listening, has been a key figure in the long-term care planning industry here in the U.S. for over 25 years now. Did I get that right, Alecia? 25 years?
You sure did, and I love every minute of it.
Yeah, and it shows. You have a passion for it. I think that's why we work well together. She's also has her CLTC designation, that's certified in long-term care. She is also I'm bragging on you now, but it's all well-deserved, Alecia, a national speaker on the topic of care in the U.S. and long-term care and solutions for it. And at present, she personally advises over 1,000 financial planning firms like ILG Financial. So we're one of thousands that she personally works with that we can tap into her expertise. So couldn't be prouder to work with you these last 18 years, Alecia, and we are well aware of the expertise you bring to the table, and we are just so thankful to have you on our team. So first of all, thanks for being here and taking the time to speak with our clients and our listeners. We sure appreciate you taking the time.
Thank you so much for having me. Excited to be here today, Dave.
Good. Well, I'll ask you when we're done because we've got a lot of questions for you today, and I want to take every advantage of the time that Ron and I have with you. And in fact, I even told Ron, listen, you're listening in. If you've got questions, Ron, jump in too. So don't be surprised if Ron jumps back in with a couple questions. So.
Well, I'm probably going to do that, so just be prepared.
So let's jump right into it. So I'd like to start with, because this comes up when you and I talk quite a bit, Alecia. What are the common misconceptions, before we even get into the long-term care specifics, what are the common misconceptions or myths when it comes to long-term care?
Well, there are quite a few, Dave. I'll just touch on the most important ones that I believe are out there. The first one is it won't happen to me. So most people don't understand that the risk is much greater than they think. In fact, 70% of people over the age of 65 will need some type of care, and 1 in 5 will need care for 5 or more years. And here's the problem, Dave. Most people think they're in the 30%, and if they think they're in the 30%, they don't put a plan in place. But as mentioned, the risks are much greater, which is hopefully something everybody will learn today. The second misconception is the Medicare or Medicaid have me covered. So how many people really think the government is going to take care of us? There are a ton of stipulations that go along with Medicare and Medicaid. In fact, Medicare, you have to be getting better or rehabilitating. You have to be hospitalized at least 3 days. And it typically only covers up to 100 days of skilled care. So it's short-term care, really not long-term care. And Medicaid, you have to spend down your hard-earned assets to qualify, and it typically doesn't cover care in the home. So ideal for those that need it, but those that can afford it certainly wouldn't want to voluntarily give up their money to be placed into a facility. The third myth is that's what my savings are for. Most people don't understand, Dave, that long-term care is expensive, and if you don't have a plan, your money is your plan. So I would encourage the listeners today to go out and really educate yourselves on what care costs. There's a great website. It's the Genworth Cost of Care Survey that can be found on the longtermcare.government website. It's just longtermcare.gov. There's a cost of care link, and it will redirect you back to the Genworth Cost of Care Survey, where you can actually look up the local cost of care. Nationally, it's running over $100,000 a year, so it's really expensive. And again, if you don't have a plan, your money is your plan. And then last but not least, this is my favorite, Dave, is my family will take care of me. This is probably the biggest misconception. And does your family know that? So think of all the families today in the country. A lot of kids are spread out all over the country. Typically, it's the oldest daughter in closest proximity. Long-term care doesn't bring families together. It tears families apart. I have a plan so that my kids will talk to each other when I pass away, and so that they can supervise the care rather than provide the care. So again, a ton of misconceptions. I think if you're going to take anything away from those misconceptions or myths, is the number one consequence for not having a long-term care plan in place, and that's how is it going to affect your family. Again, family taking care of you, sure, they're going to because they love you, but it certainly is not going to bring that family together.
You know what? I want to make a point on this because this really hits home for me. I'm kind of passionate about this. And I talk to a lot of our clients. You and I have talked about this, Alecia. In a big way, this long-term care is as much, if not more, for your adult children as it is for you. And the point is, you did a good job of touching on that if your family's going to take care of you, if you raised your children right, they're going to do it, and they're going to be glad to do it, the chance to take care of you. But the reality of this as it plays out is you have now resigned your adult daughter or your adult son, if they're going to take care of you, to be a full-time employee because they're probably working a full-time job. And when they get home, then the next 6 to 8 hours of the day, they're a full-time nurse, which means they no longer get to be mom to their children. They don't go to soccer games. They don't go to dance recitals. Family dinners are kind of a thing of the past as they're shuttling back and forth between your bedroom and doing changings and stuff. So you've basically resolved them to skip an entire part of their life that they can't get back raising their children. And what we ideally want to do, to your point, as being a manager of care, is set them up in a situation where they can bring you in and it's a positive experience where you can be taken care of by a caregiver in their house. They can still be mom to their children. They can still be daughter to you. And you can privately off in your room be taken care of by a caregiver and come out and continue to be their mother and be the children's grandparent instead of a patient in the house that's sucking resources. What do you think about that?
I agree 100%. And my friend says it best, you can either be the nurse or you can be the purse. And having a plan is really the way that you fund, that's the purse. That's the way that you fund the caregiver coming in to take care of your loved one so that you don't have to do that. And again, I think long-term care doesn't bring families together. It tears families apart. What is it going to look like for a family of 4 when you're sitting around the Christmas table or Thanksgiving table and one person is doing more of the caregiving than others? There's going to be resentment, right? Maybe one person's doing more of the caregiving. One person's telling you what to do with mom or dad's money. It can really get ugly. And I've seen kids not talk to each other when mom and dad pass away. And I think you have a much better experience if you can supervise that care rather than provide the care.
Yep, I think it's well said. So Anybody who's listening, if this didn't resonate with you, make sure you get with your financial planner. If you're with us, give me and Chase a call. If necessary, we can even set up a private call with us and Alecia and really talk this through, because this is so important. If we get this wrong, it is not going to be fixable later when you're moving in with your daughter. It's too late at that point. And the last thing you want to do is think you did everything right on the financial planning spectrum. And at the end of the day, when you do finally pass, your kids aren't speaking to each other. And we look back and figure out it's something that we could have avoided, that it was really something that we, without knowing, by default, constructed this scenario. And it's not a surprise that it happened just because we didn't address this issue. And that makes today so important. So what we want to talk about is, what do we do? So if those are the misconceptions, let's kind of talk about how do we fix it. So when would be the best time, Alecia, to start thinking about looking into or actually taking a step to include long-term care in your planning?
Absolutely, Dave. As I like to say, you've never been younger and healthier than you are today. So the younger you are, the less expensive these long-term care solutions are going to be. Because you're younger, you're healthier. The older you are, the more expensive it gets because you're one step closer to needing care. So I encourage you to have those conversations with Dave and Chase and discuss which options are best for you, because again, it's never too early to start. It really isn't. I'm 52 years old. I got a plan over 10 years ago. I think, again, the younger you are, the healthier you are, the less expensive it is. And having that peace of mind is going to be, a godsend. You're going to be so thankful that you have that plan in place. You can put it in your lockbox, hope you never use it. But if you do, you've got that way to fund your long-term care plan.
This is a wonderful conversation we're having today about long-term care. And, of course, let me remind you the way to get in touch with ILG Financial to find out about putting a plan in place for you is 540-720-5656. Now, back to more of the Retire Your Way podcast. And here once again is Dave Lopez.
Hey, thank you, Ron. So, Alecia, thanks for saying that about the best timing for it. So that really leads me into, this is where I want to spend the bulk of the time today, because this is the part of the long-term care discussion that most people have no idea. When I talk to most folks the first time about long-term care, what they believe is there's really one solution, or by default two. It's either I buy traditional long-term care, and we're going to talk about the advantages and disadvantages of that in a moment, but most folks view that very unfavorably. I don't know if that's your experience, Alecia, but that has certainly been mine. And I would say 100%. Rightfully so. We'll talk about that. Or I'm just going to put my head in the sand and pretend it's not going to happen to me because I can't process another way to do it. It's just too expensive. The good news is that's not the case, and it hasn't been the case for about 15 to 20 years. And every year these new alternatives become more attractive. So what I really want to do is talk about the two different ways we can address long-term care planning. And if it's okay as you go over them, Alecia, I'm going to kind of be the devil's advocate and push back on each about the advantages and the disadvantages to make sure we really can dig into this. How does that sound?
That sounds like a plan.
All right, so let's start with traditional long-term care. Most folks have heard that term. They're roughly familiar with it. So give me an overview of how that works, and then we'll start talking about what is good about it and what we don't like about it.
Absolutely. So traditional long-term care, in my opinion, is like renting your policy. So it is the cheapest way to buy the most amount of long-term care leverage. But if you've heard anything about the traditional long-term care insurance space, you've heard about some of the rate increases that have happened. Now, I've been in the business for, over 25 years, as Dave mentioned, so I've seen the landscape really change. And 20 years ago, traditional long-term care was pretty much the only way you could cover the risk. And essentially, it's like term insurance, or again, like renting. You're paying a premium. If you need it, you have the long-term care leverage. But again, those rates can go up. If you die and don't need long-term care, there's no death benefit. In other words, if you don't use it, you might lose it. And then third, if you change your mind, there's no exit strategy. So it's really like homeowners, car insurance. Again, if you live and need care, you've got a benefit. That's really it. And if it's the only policy you have, it's certainly the best policy to have in place when you need it. But as Dave mentioned, as you mentioned, Dave, there are a lot of alternatives now to the traditional long-term care.
Yeah, and let me add to that. You're right. I think it's a good point that you connected it to other types like auto insurance. I would say it's also just like, in a way, health insurance, right? You buy this health insurance, you're kind of locked into health insurance for the rest of your life, because the older you get, the more likely you're going to need health care, right, with traditional health insurance. The premiums go up every year. There's nothing you can do about it. But if you're lucky enough to live a healthy life for 20 years in retirement and die with your sleep, you can do the math and think, I lost thousands of dollars that I paid into that and didn't get anything out of it, correct?
That's right. That's exactly how it works.
Right, but you're stuck, right? Because it's the risk gets so high of needing medical care that as you get older, you can't say, I'm just going to roll the dice and not do health insurance to save some money. Interestingly, it's the same with long-term care. The older we get, the more likely it is we're going to need long-term care. And folks that are lucky enough to have longevity, like you said, the risk of needing care down the road goes through the roof. So we need to have it. But I will tell you firsthand, this problem of price increases is very real and frightening. Believe it or not, Alecia, and I know you do because you see it every day too, especially when we call you for help with some of these clients. We'll have folks that have been with us 5-10 years but got long-term care insurance, traditional long-term care, before they came to see us. And they'd been very happy. They'd gone 5 or as much as 10 years without any premium increases. And all of a sudden they get a note in the mail that says, we're going to increase your premiums. And it's not unusual to increase it up to 200%, with a caveat that they're going to break that up and increase it roughly 50% a year over the next 4 years to somehow soften the blow. And then the other alternative they'll give is, if you can't afford, which most folks now can't on a fixed income in retirement, a 200% increase in any expense, much less long-term care, they give you the option of reducing your benefits in order to keep your premiums affordable. Well, imagine that. Imagine paying 10, 15, 20 years for, you fill in the blank, $7,000 a month in coverage, thinking you've got that. And then you get into your early 80s, and right before you need the coverage, you've got a 200% rate increase, which you can't afford. So you're forced to reduce your benefits down to $4,000 a month just to be able to afford something. And within 60 days, you go into a facility and only have $4,000. It is a tragedy of what's going on in the industry, and it's because they guessed wrong, isn't it?
It is. When I first got in the long-term care industry, interest rates were high. These carriers, they came in, they didn't know how to price the product, so they were underpriced. The interest rates went down. It was a perfect storm, and that's why we're seeing all these carriers feel the need to raise those rates so that they can keep the promises that they made to the policyholders. And unfortunately, it's at the expense of the policy owners. I've seen a lot of carriers, some of these carriers that are offering these 150, 200, 250% rate increases, they're not even in the business anymore. So we've seen, an industry go from 40 plus carriers to roughly 4 or 5 in the traditional long-term care space. And again, it's a perfect storm, unfortunately, at the expense of clients. And I see it every day, like you said, Dave, when I'm reviewing these policies and people are stuck between a rock and a hard place. And I encourage people to keep them if they can afford them. But unfortunately, a lot of times, as you mentioned, they're having to reduce those benefits to keep the premiums in an affordable manner that they can continue on that policy in case they ever need it.
Yeah, because at that point, that is their only solution, right? Your
That's
late
correct.
70s, early 80s, you can't get any other option. So it's either reduce the coverage and take what you can get, because if you just let it go, now you've paid for nothing. You get nothing.
That's right.
So you either reduce the coverage and take a little and basically just swallow it, right? Or you somehow cut some other expense from your household to accommodate this 100 to 250% rate increase. And what came up when I first started to see this is insurance, and it is regulated by the Bureau of Insurance in each individual state. And for those of you who aren't familiar with, anytime you have these type of insurances, not just long-term care, but health insurance and auto insurance, any of it, you can't just arbitrarily raise the price like you could for the price of a car. You have to actually go to the Bureau of Insurance, and they have to approve the rate increase, which I think is a good thing. But it really begs the question, like, what in the world? I haven't seen bureaus of insurance in any other line of insurance approve 200+% rate increases. What's going on? And what I see, and I want your opinion on this, Alecia, is why in the world would the estate do that? Well, it's because they realize these companies are coming to them hat in hand and saying, we either increase these premiums by these incredible amounts or we go bankrupt.
That's right.
And so the Bureau has no option. They're like, look, we can't take on all of this, because if the companies go under, then these people are going to go on probably eventually Medicaid, and they're going to have to pay for it.
That's exactly right. And fortunately or unfortunately, it's happening. And at least these carriers are keeping their promises. But unfortunately, as we mentioned, it's at the expense of the clients who are having to pay more.
Yeah, and the world does change, right? To your point, I don't want to overly beat up on these insurance companies. Every part of how we live today is changing so quickly. 25 years ago, these companies made a guess on longevity and care, and the world, in the healthcare world in particular, looks nothing like it did 25 years ago. By the way, the state, the federal government's made the same mistakes. The problems we're having with Social Security, most people don't realize. I mean, it's not that they borrowed from the Social Security fund. That's not an issue. The problem is that no one guessed 80 plus years ago when they started the Social Security system that we were going to live to be 100 and spend maybe 5 to 7 years of that last 100 years in a facility. They thought we were going to retire at 63 and be gone by 65.
That's right. We're living longer, too, healthier lives, which makes our chances of needing care a lot greater, because if you live long enough, Dave, we can become frail, and that's when we need assistance. And that's why it's so important to look at these solutions to help cover that risk.
You're exactly right. And most people miss that, don't they? Because I don't know how many times I'll have clients say, look, I've got 2 aunts and my mother and my father, they all passed away and none of them needed care, so I don't think I will. And I was like, well, we dig down into how they passed, and it's stuff that's probably not going to cause my client to pass, right? Something that killed your father today is a pill that's going to give you 10 more years of life.
That's right.
And probably 5 of it's going to be in a facility. So you have to be very cognizant of the medical advancements and how they're extending life. And what that translates to is more need for long-term care, because what would have killed you as an 80-year-old 25 years ago is going to probably today give you from 80 to 85, and 5 of those years may be in a facility. So that's the reality of the situation, and it is, I feel like, a mission for us. You know, the more we get into it, you just realize folks can do everything right on the financial planning side, and if you don't plan for this one retirement time bomb, it can blow the whole thing up. And as you discussed, you said it so well, not only just wipe your money out because you didn't plan for 7 years in a facility at $100,000+ a year, but then you're living with one of your kids and now they're not talking to each other for the next 20 years of their life. So this is an important topic. On the long-term, traditional long-term care, for those of you who are listening, you probably got the idea that Alecia and I, probably traditional long-term care, because the world's changed, isn't our first choice. I think that was the politically correct way to say that. Wouldn't you say that?
I would agree 100%. It's still a great solution, but I think there are better solutions now with more guarantees.
Yeah, so let's talk about the other option that seems to be quickly moving to be the primary model, the asset-based long-term care. And that'll be a new idea for many people, Alecia, so if you'll bear with us, why don't you start from the basics, explain what it is, how it's different from traditional, and then we can kind of get into the meat and potatoes.
Absolutely. So, Dave, asset-based long-term care solutions. The government has allowed certain life insurance or annuity policies to be accessed while alive, tax-free for long-term care. And you have pennies on the dollar leverage for long-term care purposes. So essentially what it does is they're written on life insurance or annuity chassis. You have a benefit whether you live, whether you quit, or whether you die. So if you live and need care, you've got that additional tax-efficient leverage. If you die, and this is the beautiful thing right here, Dave, is if you die and you don't need long-term care, you have a death benefit. If you have life insurance, we know how that works, all of us out here. You die and don't need, you don't need care, the death benefit's going to go to your beneficiary tax-free. Same on the annuity chassis. If you live and you don't need care, and then you pass away, the annuity will pass to your beneficiary. So again, live, you have tax-efficient leverage. Die and don't need care, you have a death benefit. And then third, if you decide to change your mind, I like to call it an exit strategy. Depending on the solution out there, you can take some or all of your money back. So it's a great alternative to traditional long-term care. I like to use the analogy owning your policy versus renting it. And they can't go up on the rate. So you know exactly what you're going to pay. You know exactly what you're going to get, whether you live, whether you quit, or whether you die.
Boy, I love the way you said that too, because one of the disadvantages, I was going to do a little devil's advocate on the traditional. Remember how, Alecia, earlier in the call you had said the earlier you get it, the better, because you'll never be younger or healthier?
That's right.
But with the traditional long-term care, a pushback to that would be, well, yeah, but if I got it at 50, yes, it's less, but I'm paying now maybe for 40 to 50 years on this policy. Whereas if I got in later, I know it's a higher premium, but it may over time be less money total. Asset-based long-term care solves this because many of these plans, again, you set up how you want to pay for them. So we'll have clients that you and I have worked with that pay the whole thing over 10 years. So if you took it out at 50, before you even retire, while you're working, you could have paid for this, and now it's paid for the rest of your life, or you might pay over 20 years, right? And part of it's while you're working, and then maybe the first 10 years of retirement, but the premiums are locked in. They're not going up, so you know what you're getting. I really like that version, so it helps us in retirement planning. We don't have to worry about some huge increase outside of inflation for other things. This is a locked-in premium, so you can confidently build your long-term care plan into the income planning. So the other thing I like about this, and jump in if you disagree with this, but remember we talked about traditional long-term care, and we said the option was traditional long-term care or what we call self-funding, which just means, that's a fancy way to say, I'm going to take some of our savings in my 401k or my IRA, or wherever you're saving it, and I'm just going to save it the same way I'm doing, but I'm going to earmark it for long-term care, which means I'm not going to use it for trips or travel or the kids or anything else. And that way I have a long-term care bucket so I don't need long-term care insurance. That's self-funding. Well, I would suggest that asset-based long-term care is self-funding. You're doing the same thing. Now we're just talking about this idea that, hey, if I am going to set aside $100,000 or $200,000 of our money in case we need long-term care, which based on your numbers would cover, 2 years in a facility?
That's right.
Right?
If we're lucky.
What's the best way to invest it? Because I need it to grow. I think I might need 20 or 30 years, but I don't know when I'm going to need it. So if I have it in the market, God forbid, what if the market drops like it did in 2008, 56%, and a month later I need long-term care? Right? So now my 200 turns to 100, and now I've only got one. So the market's not a good place for it. So asset-based long-term care, let's talk to me a little bit about why that's the perfect way to self-fund, because you've got, like you had said, the best of all worlds. You're still setting the money aside, but you're setting it in a vehicle that gives you a huge return on investment if you need long-term care. If you don't need long-term care, like you said, it passes to your heirs. And I would say the only disadvantage to long-term care, asset-based long-term care, and I think this is actually a good thing, is if you lived 30 years and died in your sleep and never needed the care, your heirs will get a death benefit, and that rate of return will be pedestrian. Maybe like you received in a bank account over 30 years, or you might even get just a little less than you put in. So that would be the only disadvantage to it, is that you got a lousy return for your heirs, but the trade-off is a huge return tax-free if you need the coverage. What do you think of that?
I agree 100%, and I think don't discount the tax favorability as well. I mean, you mentioned it, but in my opinion, I mean, you think about it, if your money's growing and you get an average rate of 6 or 7% over time, and then you need to take that money out, that's a pretty big tax hit if you need to use that money for care. And again, if you haven't allocated something, you've allocated everything. This is just a more tax efficient way to take out your money, and you have the pennies on the dollar leverage. And people understand and they understand insurance, they understand leverage, and it's just a beautiful thing to be able to say, hey, I've taken care of this risk. It's off the table. I'm going to put this policy in my lockbox. If I need it, I've got the tax efficient leverage. If I don't need it, I have the death benefit. And if I want to quit, eventually, if I change my mind, I've got that exit strategy. It's just an easier conversation to have. You're owning your policy versus renting it. Not that renting is bad. Again, I don't want to discount traditional long-term care because it is good for those that need it and those that have it in place. It's just that I believe there are better alternatives with more guarantees now. And that's why Dave and I really love these solutions. They are a great alternative. And it's just a great way to cover that risk. And you're going to win no matter what. You're going to win if you live. You're going to win if you die. You're going to win if you change your mind.
Yes, and comparing it to another investment that you would just earmark for long-term care, this goes to this idea of in retirement, when you pick an investment, the investment needs to be designed to best fit how you're going to use the money as opposed to when you're saving for retirement. So, for example, if you're going to use your money to take $1,000 out a month to live off of, there's very specific ways we would recommend you invest that money to give you the best chance of success.
Right.
Whereas if I'm going to use this money for long-term care, what are the parameters for that bucket of savings? Well, one is I don't know when I'm going to need it. God forbid I have a car accident. I might need it tomorrow. Correct?
That's correct.
Right? Or I could go 30 years without needing it and then need it for the last 3 years of my life and need $100,000 a year. Or I may go 30 years and never need it. So that puts very unique parameters around how we invest the money. That's why I said you probably wouldn't want that money in the stock market for the reasons I had said. But when we talk about, you kept saying this idea of pennies on the dollar, to give folks an idea of the rate of return, why this is so attractive. Now, let me disclaimer this by saying the policies are all different for everybody depending on how old you are and your health situation. But it's not uncommon that someone could take and, for example, put $200,000 in, and if they, God forbid, if they needed care for one or both of the people on the policy, it could pay up to 5 times or more, up to $1 million or more, tax-free in care. That's a great rate of return if you're earmarking that money. And that's what we look for in our financial planning with our clients is no matter what your goal of a bucket is, whether it's income for life or in this case, to protect your family's assets against huge long-term care costs. When we look for an investment, what we're looking for is what's a strategy that uses as little of your money as necessary, has as many guarantees as possible, and can give you the biggest payout for whatever that distribution need is. And in this case, if it's long-term care, this is really going to be a hard investment to beat if the goal of the bucket is to make sure I've got adequate care.
And I would agree 100%, Dave. I think when people see these solutions sometimes, I think one of the downsides, if you call it a downside, if you need it for care, it's obviously the best fit. I think what people don't understand is if you don't need it for care and you pass away, could you put $200,000 into a plain vanilla life insurance and get a bigger death benefit? 100%. You certainly could. This is really long-term care first. The life insurance is secondary on the life chassis, and on the annuity chassis, it's the same. There's no sexy income riders. You're really not buying it for accumulation. You're buying it for long-term care leverage. So these solutions are fantastic if you need them for care. If you don't need them for care, here's what I say. If you don't use it, you don't lose it. That death benefit or the premium that you put into the policy, 9 out of 10 times you're going to get that back and then some to go to your beneficiaries.
You said it perfectly. And the key here is, and this is true of any investment in retirement, is you got to pick your poison, don't you? There is no perfect investment. So you just have to decide for each bucket, what's the primary goal of that bucket? You can't be everything. A huge death benefit if I don't need it, and a huge payout for long-term care if I need it, or a huge payout if I want to walk away. That investment doesn't exist.
That's right.
Just like if we're in the stock market. The advantage to the stock market is possibility for a huge payout if the market goes through the roof. But doesn't give you complete protection if it doesn't go through the roof and still give you a huge payout. So we're always picking our poison, right? So the idea here is just be very clear with this bucket. What's the primary use? Is it a huge payout to your children, or is it primarily to protect your family's assets from a long-term care drawdown? So if it is long-term care drawdown, this is a very viable option that you want to take some time to look into. So thanks for that, Alecia. I want to say that if for those of you that are listening, if this is new to you, or if you have any questions about how this works, get with your financial professional. If you're with ILG Financial, we've probably already discussed this, but if you want to revisit it, just give us a call, get on the calendar. Chase and I will walk you through. If necessary, we'll get Alecia on the phone. If we want her involved in the conversation, she's available. And I appreciate that, Alecia, that you make yourself available for our clients. But I want to move on from this topic, but I do want to let everyone to know it is not too late to act on this. If you're thinking it's too late, just give us a call and let's just take a look and see if it's a viable option for you. Did we miss anything?
I don't think so. I think we've covered a lot of it.
Good. Well, listen, let's close with this one idea, because when we talk about the world changing with technology over the last 24 months in this sector of the financial industry, we've seen some huge changes that have been really an incredible tool for us to give the client a really good picture, more personalized picture, I think is a good way to say it, of what the future might look for them with respect to long-term care based on their specific situation, as opposed to just a generic being somebody who lives in Virginia. So tell me a little bit about that software that we have access through you with Water Lily, and how it could be used, and how the client, if they might be interested in it, if they want to reach out to us to run a report.
Absolutely, Dave. Water Lily is one of a kind. It's the only platform I've ever seen in the long-term care industry that will really help users or listeners here today personalize their long-term care story. So what Water Lily is, Dave, is it's a predictive AI platform where you can, as the client, can fill out a 3 to 5 minute intake form, and based off of 500 million data points and 50,000 families like you, it's going to predict when you might need care, how old you might be when you need it, the likelihood of needing it, how long you might need care. And most importantly, what I value in this software is it is going to personalize your story, meaning what kind of care settings do you want? You're going to actually go through the process of deciding, in early care, do I want to receive it in the home? Do I want to receive it in an adult daycare facility? Do I want to use an assisted living facility? And then you talk moderate care. And it's going to show you how many family hours your kids or family is going to step in and take care of you. Again, it's going to personalize that care story for you. So rather than drawing a line down the middle with statistics, 70% of people need care, it's going to actually predict your story, what that's going to look like. And then we're going to actually see how much that care might cost. Again, family hours stepping in, and you can zero those families out. Most people don't want their family to take care of them if they can help it. So you can zero those out. It's going to predict how much that care might cost. And then we're going to be able to take a solution and be able to take that risk off the table. So whether we want to model self-funding, or we want to model a long-term care solution, or maybe a life insurance with a chronic illness rider, or annuities with income doublers, or the combination of a few solutions, we can show you how we can take that risk off the table. So I believe that Water Lily is going to personalize your story. It's going to help you understand that, number one, the risk can be much high, but the consequences of not having a plan in place. So I would certainly encourage you to run a real-time care analysis for you and your family. Your situation is different from your neighbor's situation. So that's, in my opinion, the number one thing you should take from this today is reach out to Dave and Chase and the team and get your story. See what that story looks like. And let us help you. You don't have to decide on your own. Let us help you put a plan in place, whether that's paying for it yourself with self-funding or putting a solution on the table to take that risk off of you personally.
Listen, I appreciate that. And for those of you listening too, if you want us to run a real-time care analysis using this AI predictive Water Lily software, it's quite extraordinary. We will do it free of charge. All you have to do is reach out to us and let us know you want us to run it. The only cost to you, if there is a cost, would be the 3 to 5 minutes it's going to take you to go through and fill out the questionnaire, and then we can kind of go over it together. We're glad to do it. It's that important to us that you have that information so that you can make an educated decision, and then from there, we have the information to formulate. Alecia and I can get together with her team and formulate a solution that's probably a unique solution for you based on this new data that we have. So please take advantage of this. There's really no reason not to do it. Just give us a call. Ron will give you the phone number or a website. You can go right through our website and request a meeting for us, and we can kind of talk about it. Alecia, we are out of time. I took you over what I promised. I apologize, but it's just so important that I wanted to sap every bit of juice out of this orange that we squeezed with talking to you about it. And I thank you for taking the time to talk with us and our listeners. It's just a blessing to have you working with us. And I think we're going to get quite a few folks reaching out with the water lily analysis. And I appreciate you helping us to get that. Any closing words?
Well, Dave, I appreciate you having me here today. Remember, folks, you've never been younger and healthier than you are today. You know, everybody's situation is different. It's not a one-size-fits-all approach. That's why it's important to talk to a financial professional about your care needs today.
Hey, Dave, let me just say that earlier in the podcast, you asked me to ask questions if they popped into my mind, but you two have done such a great job covering so much ground and doing it so well. You anticipated the questions that I have, and I appreciate all the education today.
I appreciate you, Ron.
Well, listen, the good news is we're living longer. The bad news is we're living longer. It's essential to have a plan in place to take care of your long-term care needs. And those who don't even think of the potential need for long-term care are making a serious mistake. If you'd like to find out more, why not get in touch with ILG Financial? And, of course, you can get a real-time care analysis, as Dave and Alecia have discussed. You could do that by calling 540-720-5656. That's 540-720-5656. But it's all right here. Income, legacy, growth, right here at ILG Financial. It's about helping you plan for retirement your way so you can achieve your financial goals, whatever they are. Call ILG Financial at 540-720-5656 or go online to ilgfinancial.com to learn more. This has been the Retire Your Way podcast with Dave Lopez and Alecia Barnette. Thanks for listening. Join us next time. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.
Hey, Chase Lopez here. Thanks for listening to Retire Your Way with ILG Financial, our podcast. Make sure you head to our YouTube channel as well to check out our video series, Retire Your Way with ILG Financial. Also, don't forget to subscribe and like our videos there so you can be alerted for any future videos. Talk to you soon.